Professor Karn with you to go over how to estimate bad debt expense using the allowance method. We're going to look at each of the three methods: percent of sales, percent of receivables, and aging analysis of accounts receivable. And then we'll also do a separate problem on how to do a notes receivable transactions. Okay, so let's look at this first one here. We're going to look at percent of sales method. It says during its first year of operations, Signature Lamp Company earned net credit sales of $314,000. Industry experience suggests that bad debt will amount to 4% of net credit sales. At December 31st, 2016, accounts receivable totaled $45,000. The company uses the allowance method to account for uncollectibles. Okay, so the first thing we have to do is to journalize Signature's bad debt expense using the percent of sales method, and then in the second requirement, show how to report accounts receivable on the balance sheet at December 31st of 2016. Okay, so the way that we're going to do this is, it's pretty straightforward. Anytime you use the percent of sales, you always have to look at the percent of sales on credit. So in order to do this journal entry, this adjustment, we have to take the 4% times the amount of sales on credit, in this case, which was $314,000. So our adjusting entry is always to debit bad debt expense. And we're going to take $314,000 times 4%. So to get that number, we'll just take that and do that here in Excel. 314,000 times 0.04. And we get 12,560. And then that's what we will also have to credit allowance for bad debt for. $12,560. Okay, so that's the only thing you have to do for requirement 1. That is the adjusting entry in the journal for that. Now in requirement 2, I've already up here kind of done the preliminary work here to help us calculate accounts receivable net on the balance sheet. Remember, to do that, you have to take your accounts receivable balance. In this case, we started out with $45,000. And in this case, we'll have to subtract the current balance. The only balance we have of the allowance for bad debt will be the $12,560 that we just calculated. So we will take and do the calculation, 45,000 minus the 12,560, and you can see that our accounts receivable net is 32,440, and that's what we will use on the balance sheet to add up to get total assets. Okay, so that concludes the percent of sales example for the allowance method and estimating bad debt expense. Let's pause here for a moment, and then we'll get to percent of receivables. Okay, now let's take a look at how we do percent of receivables. And this problem is going to be a little different, and you'll see why from percent of sales, how this is different as far as calculating our amount of our adjusting entry. Okay, it says the accounts receivable balance for Field Company at December 31st of 2015 was $25,000. So I put that over here in a T account right here. And then it says during 2016, Field earned revenue of $457,000 on account. So because of that, that would increase accounts receivable. So we'd had to debit that. So 457 would go here. And then we collected $326,000 on account. So that would mean that accounts receivable would decrease because we got the cash. So we'd have to credit that along the way. And then we also, in this case, wrote off $5,900 of receivables as uncollectible. So that would also reduce accounts receivable. So now we can get a balance, oops, not 590, but 5,900. Okay, so now we can get the proper balance here by taking the 25,000, adding the 457, subtracting out the 326, as well as the 5,900. There we go. So we see that our current balance of AR is $150,100. Okay, so let's do some calculations here. It tells us that industry experience suggests that uncollectible accounts will amount to 4% of accounts receivable. So we have to take 150,000. I'm just going to do the calculations here in the journal. Just write this in here like this. So 150,000 100 times 4%. So when we do that, so let's come over here and just put it over here, plus 150,100 times 4%. Notice that we get $6,004. I'm going to take it out of the debit column. I don't want to confuse anyone here. I'll just put that over here, 6,004 there. Okay. Now, let me just state what this means here. The 6,004 number, this amount must be the ending balance of the allowance for bad debt after the adjusting entry. So this confuses a lot of people. So what we want to be careful of here is, and the best way to look at this is to set up T accounts so that you get this correct and you don't get the adjusting entry wrong. So it says in requirement 1, assume field had an unadjusted $2,300 credit balance in the allowance for bad debt at December 31st of 16, and to journalize field's December 31st, 2016 adjustment to record bad debt using percent of receivables method. Okay, so I put that down here. So it tells us that we know that it's 2,300 credit to start. So we have to have a 6,004 ending balance. So basically the way that we would look at this is you could put X there because the X figure is the amount of our adjusting entry that we have to make. So if you think about this and you'd solve for X, basically you would take X plus 2,300. I'll just write it out over here. X plus 2,300 equals 6,004. And remember, in this case, to get X by itself, we would subtract 2,300 on both sides. Okay, 6,004 minus 2,300. Let's do it like this. There we go. So in this case, X would equal, and we can do that over here real quick. So to get this number, we would take plus 6,004, subtract out 2,300, and you can see that X equals $3,704. And what we want to look at here, and I'll just kind of put the X over here so you know what that's for there. Make that a little bit larger so you can see it. Okay, so what you want to realize here is that in your adjustment now, and again, we are still at December 31st of 2016. And our adjusting entry will be the same as far as the accounts are concerned. We'll debit bad debt expense for $3,704. And we will credit our allowance for bad debt. $3,704. So that takes care of requirement number 1. Now, the only thing that they do in requirement 2 is they tell us that assumed field had an unadjusted $1,900 debit balance in allowance for bad debt at December 31st, and they want us to journalize field's December 31st, 2016 adjustment to record bad debt expense using percent of receivables method. Now, here's what some students struggle with here. If we have a credit balance, a debit balance of $1,900, we still have to get to a $6,004 credit balance at the end. That's not going to change, and we still have to solve for X here. Okay? Now, what we have to realize is that, remember, estimating bad debt expense is not exact, hence the reason it's an estimate. So in this particular case, we may have written off more accounts receivable than we had anticipated. So as a result, our expense is now going to be higher. So in this case, for requirement 2, our formula would be X minus 1,900 equals 6,004. And so to get X by itself, we have to add the $1,900 on both sides. And you can see that the calculation will yield a higher amount of bad debt expense in this case. So we know that X is going to equal 7904. Okay, so we'll take X out of here, put 7904 there, and I'll copy this, just put that down here again for you there, so you have that. X there, so you can identify that. Okay, so then our adjusting entry in requirement 2 would be the same accounts again, except the number will be, oops, let's get down to 1231. Bad debt expense for 7904, and then a credit to allowance for bad debt for 7904. So again, the key part to this problem is understanding that anytime you use the percent of receivables method, whenever you take the amount, your current balance of accounts receivable times the amount that you estimate that of accounts receivable that you will get that will be deemed uncollectible, this number must be the ending balance of the allowance for bad debt after the adjusting entry. Okay, so that concludes this example for percent of receivables. Let's pause here for a moment, and then we'll look at how to do an aging analysis of accounts receivable. Okay, let's look at an aging analysis of accounts receivable. I like this method because what you're going to see here is that where, unlike the first two methods that we looked at, we're really not factoring in the length of time that something has been either due or past due. So let's take a look at this and see how this works. It says world-class work shoes had the following balances at December 31st of 2016 before year-end adjustments. And our current accounts receivable balance is $78,000. And our allowance for bad debt is a credit balance of $1,060. Then what they're going to give you is a breakdown of the aging of accounts receivable. And what that is that it's going to categorize the current state of accounts receivable according to different groups of time. In this case, we have a very basic example. We have just two categories. We have a 0 to 60 days past due, and then over 60 days past due. And then in some cases, you may have a not yet due column. You may have a 1 to 30 days past due, 31 to 60, 61 to 90, so forth and so on. So in this case, they made it very simple for you. And they want us to journalize World Class's entry to record bad debt expense for 2016 using the aging of receivables method. It's also called really an aging analysis of accounts receivable. And then to prepare a T account to compute the ending balance of allowance for bad debt. Now, this is going to be very similar as far as what we're looking for to the percent of receivables when we talk about looking for the amount for our adjusting entry. So how do we do this? So let's do some calculations. What you have to do is you're always going to be given the amount that they deem uncollectible in a percent form. So you can see that for the 0 to 60 days category, the estimated percent that's deemed uncollectible is 2%. And then anything, in this case, over 60 days past due is actually higher at 24%. So the way we're going to look at this is we're going to take the 73,000, we're going to take each category, so 73,000 times the 2%, and then we're also going to take the 5,000 times the 24%. So if you had more categories, you would do the same exact thing. So let's do some calculations here. We'll have Excel to help us out here. So we'll do 73,000 times 0.02, and that's 1460, so I'll put that over here. And then we have 5,000 times 0.24, and that comes out to be 1,200. So we'll put that here. Okay, and then what we want to do is we want to take the 1460 plus the 1,200, and I'm accidentally hit my screen with my hand there, so I apologize for that. There we go, we fixed that now. Plus the 1,200. So that equals 2660. And just like the percent of receivables method, this amount must be the ending balance of the allowance for bad debt after the adjusting entry. So we have to again solve for X. So let's bring down here. We know from this T account up here, it's 1060 on the credit side, which I've set up here. So we know this is going to be X again. And we know that we have an ending credit balance of 2660 here. Okay, so let's do our formula. So again, this would be X plus 1060 equals 2660. And we got to subtract the 1060 to get it the X by itself. So we got 2660 there. Whoops. Come back. There we go. Minus the so X comes out to be, and we'll come over here, we'll take the, we'll just go ahead and do it right here. we'll take the 2660 minus the 1060, and you can see that we get an even $1,600. I'll put X there just so you know. So we know that X equals 1,600. And we know that we have to do that as our adjusting entry. So again, we're in 2016, 12/31. We will debit our bad debt expense for 1,600 and credit our allowance for bad debt. Again, the key thing here is make sure you get the proper ending balance based upon your estimates and doing your aging analysis, your categories times your percentages. That's got to be your ending balance of allowance for bad debt after the adjusting entry, and then just make sure you solve properly for X. Okay, so that concludes the 3 different ways we can estimate bad debt expense. Let's take a look at the other part of this material and take a look at a notes receivable problem illustration in the next one here. I'll pause the video for a few seconds. Okay, let's take a look at a notes receivable problem here. It says on December 1st, coal company accepted a 120-day 6% $17,000 note receivable from J. Peterman in exchange for his account receivable. Just a comment on that, in some cases, what companies can do, what businesses can do is, in order to give someone a time extension in paying what they owe, they may convert their account receivable into a note receivable so that now you have more time to pay as the customer, but because the company's giving you that benefit, you're now going to have to pay interest expense. And in this case, coal company is going to earn interest revenue in order to grant that time extension to J. Peterman. So let's take a look at these transactions. It says here on 12.1, it says that we have to journalize that particular transaction, and that's really the issuance of the note. So in this case, we would debit notes receivable. And that was for J. Peterman. And it's probably pretty wise of you to go ahead and label each person that is borrowing money from you and that we're getting, having a note in their name. You want to make sure that you track this properly, because if you don't, then what's going to happen is that you may have a situation where someone calls you up and says, I want to know how much I owe on my note, and you need to certainly have that information readily available to them. So just keep that in mind. Okay, so that would be a debit for $17,000, and then we would credit in this case because they're substituting out, basically paying off their accounts receivable with the note, basically just transitioning it from an account receivable to a note receivable. 17,000. And you could certainly have put the name of the individual there as well, because, and again, it goes back to just tracking this properly. But remember that accounts receivable is as a whole is called, it's a controlling account. Just know that accounts receivable will be made up of a whole bunch of subsidiary ledger accounts with each customer name. Again, anyone who calls us up, we've got to be able to tell them exactly how much they owe so they could pay us if they would like to. Okay, now here's where it gets a little trickier. It says, journalize the adjusting entry needed on December 31st to accrue interest revenue. Well, in this case, the end of the year is occurring, and we have earned interest, and we must show that that interest has been earned in this accounting period. Otherwise, we would violate the matching principle. We would not have properly matched the revenue and expenses in the period in which it was occurred. In this case, we would not have matched the revenue in the right period if we would have pushed it all into the next year or 2017. So let's do some calculations. Remember, to calculate our interest, we would take our formula I equals PRT. So in this case, we will have interest equaling the principal, in this case is 17,000, times the rate of 6% interest, times the time. Now, remember, we always use 360-day years in this case. So we see that from December 1st through December 31st, we have 30 days out of 360 have elapsed. So when we do that calculation, notice that we would take 17,000. I'll do that out here so you can see how this will work. 17,000 times 0.06 times 30 divided by 360, and notice we're going to get $85 is the amount of interest that we have earned. So I'll put that down here. So I equals 85. Now remember, this is an adjusting entry because the note is not being paid or maturing at this particular time. It's just that we have to record the interest in the proper period. So we are owed the interest and we have earned the interest. So to record this adjustment, we would debit interest receivable because we are owed the interest, $85, and we would credit, let's move this down a little bit there, interest revenue. For $85. Okay. So now we have to journalize the collection and principal of the interest at principal and interest at maturity, and we have to specify the date. Just so you know, if you're asked to do this in my accounting lab and you happen to get it wrong, I'm not going to be too concerned about that. Using 30 days for each month gets somewhat confusing for students as far as when you're calculating the date. Technically, you still have to calculate it properly. But obviously 120 days from December 1st would be a maturity date of March 31st. But we have some calculations to do before we get to that point of doing the journal entry. Okay, so we know, let's look at this and do the calculation for the whole thing. So we know, again, I equals PRT. And we know I equals the principal of 17,000 times the rate of 6% times the remaining days in the note would be 90 for this accounting period because we've already calculated the other 30 in the other period. Okay, so let's go ahead and do that calculation. So we would take 17,000 times 6%, 0.06, times 90 divided by 360. And we see that we get $255 is the amount of interest for this period. Okay, so now we should be able to do this pretty easily. So interest equals $255 for this period. All right, so let's go ahead and see what's going to happen here. We know that we've already accrued $85 of interest, so let's go ahead and get the total amount of interest. That would be 85 plus the 255. So we have plus 85 plus 255, and we get $340. So I'll put that here. And you could always, oops, I forgot my T over here. You could always calculate this out too. If you wanted to try it out, you could take the I equals PRT here and say that it was 17,000 times 6% times 120 divided by 360. And you would see that if you did that calculation, and I'll prove that here, plus 17,000 times 0.06 times 120 divided by 360, you can see that we get, oops, I forgot to add a 0 here to this. I only had 1,700, so let's do that. So you can see that we get the 340 to match the total amount of interest that we've calculated. Okay, so the journal entry is a little bit different, however, though. And what you want to do here is you want to make sure that you properly record this payment at maturity on the 31st of March. Now, obviously, anytime we're receiving the payment of a note, cash is coming in, and that will always be, and I'm just going to put these notes here to help you. Remember, it's maturity value. Remember, that's the principal plus the interest. So that would be 17,000 plus the 340, so 17,340 in this case. Now, we know that we've earned interest revenue in this case of, for this particular period, the new accounting period from January 1st through the 31st of March, that was $255. And then remember that we have this interest receivable here that is no longer going to be owed to us because they're paying in full, so we can get that off the books by crediting it and reducing it to 0. And that was for 85. And then now remember that they're paying off their note, the principal amount, in this case the notes receivable, is credited for the $17,000 amount. So you can see that we've received cash for the full amount of maturity value, which is principal plus interest, $17,340. We've earned additional interest revenue from January 1st through March 31st of the new accounting period of $255. We are receiving the interest that was owed to us and being able to reduce the interest receivable to 0, and then also being paid back the note in full of $17,000. So you can see how this works here. Again, the confusing part of this is typically the adjusting entry to make sure you do the proper amount of interest to recognize in the correct accounting period. Just make sure you don't fall into the trap of using 365-day years. You want to make sure you use 360, and you should be fine. Okay, so that concludes this video of this material, and we'll get ready to look at how we're going to wrap things up here.